Good morning, everyone. I think we will kick off. There might be a few stragglers joining us, but it's a pleasure to have you all here with us today. The topic of discussion is a big one. All you need to know about transfer pricing Zimbabwe. We've got an hour, so we'll do our best to cover as much as we can. I'm Cabrini from Regan van Rooy, and this seminar is in conjunction with Chapmans Chartered Accountants and Hammond Des Fontaine, who I'm sure many of you already know. So thanks everybody for joining us today. Hammond, do you want to introduce yourself quickly? I'm just going to move the slides here.
Good morning, everyone, and welcome. Looking forward to doing this presentation today. Just introducing myself, like Cabrini said, most of you probably know me. I'm a Zimbabwean Chartered Accountant in professional practice. I've been in the profession for quite a number of years, over 28 years, focusing previously I was with Deloitte as the lead tax partner. Prior to that, insurance partner. Since leaving Deloitte, I've been practicing on my own, focusing mostly on tax and corporate finance type work. I've worked with Cabrini in the past, from our days that we were both at Deloitte at one point in time. So I've known her for a long time, and it's good to be co-presenting with her once again. We had done quite a lot in the past together. Would like to also just thank Chapman's Chartered Accountants who co-hosting this event. Most of you may also be familiar with Chapman's, which is a professional services firm in Zimbabwe, focusing on a wide range of offerings from accounting, audit, tax, corporate finance, due diligence work, and internal audit, as well as a big secretarial service offering. Thanks to them, a lot of you who are attending have been introduced to this meeting through them. Thank you.
Perfect. Thanks, Hammond. And yes, on the agenda today, we're going to basically give an introduction to transfer pricing and talk about some of what's happening globally. Then we're going to look at the specific Zimbabwean transfer pricing rules, where we've had much movement of late. We're going to look at the specific TP documentation requirements in Zimbabwe, and then Hammond will talk us through what we're seeing from ZIMRA and some of the key trends specific to Zimbabwe. A couple of wider considerations, and of course the big one, next steps. So Hammond has introduced himself already, and just briefly on me, as Hammond mentioned, we're ex-Deloitters for our sins or for our fortunes, who knows. I started off in transfer pricing with Deloitte London, was then tasked to come to Johannesburg originally on a secondment. And then South Africa took me under its wings, and I was there for over 7 years. There I worked across Africa in all the various jurisdictions, particularly in Zimbabwe. Hammond and I worked together since the legislation came about to try and prepare taxpayers for the transfer pricing environment, which, as many of you will know, is not easy. Regan van Rooy is a boutique international tax firm, and we offer the full services from a transfer pricing perspective. So we always think the best type of partnership is you have your transfer pricing expertise, and of course the in-depth local knowledge that you always require when you're dealing with specific tax authorities. So what is transfer pricing? It's not an easy question to answer, or maybe it is, but essentially the increased internationalization of business has started to bring a lot of scrutiny around by global tax authorities on intergroup transactions. And as a result of this global focus, TP has become one of the most critical and controversial areas in tax and in international business. Many of you will have heard of the base erosion and profit shifting project and all the work that the OECD has been doing. This activity has essentially brought about a new wave of updated and generally globally consistent, but we will talk about the specific local Zimbabwean tweaks across the globe. It's a result of a focus on this avoidance of profit shifting, and each tax jurisdiction demanding that the appropriate profit is earned within their tax jurisdiction such that it's not being eroded through international structuring. The world is demanding tax transparencies. We've seen things like the Panama Papers and the legislation which has come about, but the documentation which is being shared with other tax jurisdictions. So we have transfer pricing documentation such as country by country and master file, which are available to be shared between various tax jurisdictions. So there's a lot of focus essentially around TP. TP is essentially a tug of war between the two tax authorities. And in transfer pricing, we have to look at not just the Zimbabwean side, but also the other side, because by definition, arm's length is supposed to keep both tax authorities happy. But it is subjective and it requires comprehensive analysis to support it and to satisfy the tax authority in either jurisdiction. Broadly speaking, transfer pricing focuses on cross-border transactions between connected or associated persons and whether or not these are arm's length. In Zimbabwe, of course, you have this added difficulty of also having to look at domestic transactions, which is atypical from a global perspective, but is mediumly common from an African perspective. So it is an additional painful part of the transfer pricing process that's relevant for Zimbabwe. The second additional layer of complexity is probably around what is a connected or associated person. Zimbabwe has taken a very wide view of what that is, and Hammond will talk in depth on that later, because obviously, need to know what transactions are covered and who are associated parties to make sure that you can comply with the legislation locally. The big picture principle around transfer pricing is that profit should follow value creation. And as part of the documentation process, we're essentially looking at how you split up profit or costs between group entities. And we need to look at the supply chain and how that value is created to determine how that split can be supportable from a transfer pricing perspective. And of course, that's complex in itself. Even if you are just doing it for business purposes rather than transfer pricing purposes, it's not a simple mathematical exercise, which is why a lot of people and tax authorities are often debating over all things transfer pricing. The onus is on the taxpayer to prove that the transactions are arm's length. And how is this done? Because it's not just done through conversation or through, internal documentation. It's done through various forms of documentation, the core one being your transfer pricing documentation, the corresponding financial data that needs to be incorporated into that, and your legal agreements. We're going to talk in detail about what is this TP document, but essentially it contains core components that are acceptable in local and global legislation to discharge this burden of proof. So essentially your documentation is designed to be able to say, this is arm's length and this is why. Tax authorities, please give me a break. There is a big focus on economic substance over legal form. So we often have a case where legally we've said we're a service provider and this is the charge, and that used to be okay. But now a big focus of transfer pricing is legal only means so much. You have to look at the economic substance and the actual activity that underpins the legal arrangement. So that's quite a lot of work, and there is a big focus on that in the transfer pricing documentation itself. There is also a global focus on the significant people function. And this is often the case if you're transacting with a low tax jurisdiction. Do they have the significant people function to perform the activity that they're legally supposed to perform? And do they have the true ability to control and manage risks? There's also a big focus on the value chain. As we said, you don't just look at the transaction, you look at the transaction in the context of not just the local business, but in the context of the party on the other side of the transaction and their value chain, and sometimes in the context of the wider group. Why does it all matter? Because the fact pattern and the economic realities underpin what we can support as an arm's length remuneration. So to try to simplify this, essentially what we're doing is saying, who does what with respect to a related or a cross-border transaction? What's the economic significance of that activity? And as a result, how much a profit or cost should they pay or earn with respect to that transaction? So it's pretty simple, right? Transfer pricing is governed by the OECD guidelines. Generally, this is even in non-OECD countries. Zimbabwe is broadly aligned. Zimra might not always be fully on board, but the principles are broadly aligned. But Zimbabwe does have very specific local considerations that cannot be ignored, including the definition of the deemed associate and the cross-border limitations and various other things we need to consider. So who cares about transfer pricing? Is it just geeks like myself and Hammond? Unfortunately not. The tax authorities really have this as their primary focus at the minute. Because why? Because they think that there's money in it. And with things like COVID happening, and all tax authorities crying out for more revenues, transfer pricing has even become more of a focus. They don't look where they don't think there's money. So if there's an international presence, they think there's some money in it, they're going to spend their energies on it. Regulatory bodies are also need support on a transfer pricing perspective, whether that's your regulatory bodies specific to your industry or reserve banks and so forth. Taxpayers obviously care because it's a matter of compliance and managing of your tax risk generally, in particular, even though we have domestic transactions for groups with an international presence. Your stakeholders care, mainly because everybody else cares. And the type of exposures that can arise from transfer pricing can be high value and take up a lot of resource time. The public also care. You'll see a lot of the principles of transfer pricing were touched upon in some respects in the Panama Papers. And any type of activity which is perceived as eroding, particularly a developing country's tax base, attracts superbly negative reputational considerations. So it can really impact your business. And transfer pricing is essentially, because of all the work that globally is being done, just super high on everybody's radars. So transfer pricing, it's not just a normal compliance issue, it's also a risk management issue. But on the positive side of it, there are also opportunities if you plan and support your TP framework correctly to have business model optimization opportunities. But transfer pricing has gone from kind of a theoretical exercise to having a much more concrete framework in place. So globally, what we've seen again is the new legislation and everybody coming up to speed with the OECD standards. Brazil, for example, who have always said, no way, we're never going to follow OECD, have just announced they're going to follow it. So any people who kind of didn't follow the principles found themselves falling behind, because you're generally going to be dealing with a tax authority on the other side that does follow the principles. So as a result of this, and particularly in Africa, and including with Zimra, there's been an upskilling of the tax authority and an increased audit focus on all things transfer pricing. So transfer pricing disputes and various reallocation of resources, you'll see it in various budgets, aligned with basically the increased political interest in TP, is that there's more people in the tax authorities actively focusing on your transfer pricing. Internally, all of this, of course, increases your compliance burden. And for a lot of tax teams and businesses, transfer pricing is relatively new. So there's a whole lot of internal upskilling that needs to be done to essentially figure out what does your business need to do to get up to speed with transfer pricing, given there really isn't much of an alternative option. This has brought about essentially people re-looking at their business and their TP models. And we've seen a lot of shift in how we have been doing transfer pricing previously to make sure that our models are robust enough to align with the current environment. I think I mentioned before, implementation and evidence. We now just can't say, no, our prices are arm's length. You know, we base it on this external data. We do the same with our third-party customers. That's great, and it's a basis. But you actually have to evidence this now in a formulaic way, which is included in your TP documentation. It's not just okay to, you know, to in principle think it's okay. You actually have to apply your transfer pricing principles to prove it. Documentation is also an opportunity. It's not just compliance. This is your core narrative to the tax authority about your business, about how you do your business, about your transfer pricing policy and models. And that's critical. That narrative to the tax authority, it forms the basis of your defense always. And where we have seen issues is people not having appropriate documentation in place that's not robust enough. And there we see challenges. And after the fact, it's much more difficult to defend your position because the tax authority looks or should look, and Hammond will talk to you about how Zimras sometimes seem to ignore your transfer pricing documentation at times. But it is the basis of your defense. The whole process then, of course, requires implementation and monitoring. You can't just have a policy and then the business does what it wants, because you have to prove it with real numbers at the end of each year. So this requires essentially creating certain types of internal processes or policy guides or procedures, and certainly some level of awareness internally in the business as to what transfer pricing is, when they should be flagging something to the tax manager that there's a TP issue and things like that. And to be able to do that is very, very critical. And that requires people to have in the business at least a base understanding of what transfer pricing is. And before I go on to this, I want to comment, because I forgot to do it earlier. There is the chat box and the question and answers there. Please raise questions as you go along, and either Hammond and I will endeavor to address them, or at the end, hopefully we'll also have time for some questions and answers. And of course, if we don't get to it, because there's quite a lot to cover, you can email either of us and we will deal with whatever questions you have. So that would be our pleasure, of course. So now we want to look at low-hanging fruit. What type of transactions, you know, are really being challenged? What we've seen globally and in Zimbabwe is IP and intangibles, and a big focus on this. You know, how are groups charging for brand intangibles, operational intellectual property? What is intellectual property in the context of your business? Because even if you haven't thought about it before, you actually now have to cover it in your documentation. So there's a lot of focus on this because they tend to be high value transactions. And the global historic trend has been to house your intellectual property in a low tax jurisdiction, but not have substance there. So this has become a key area to look at. It needs to be covered whether or not you charge it. You need to address it as a core part of your business. Financial transactions, you'll see loans, whether they're interest free, what is the quantum of the loan. These type of transactions, you need to support that the value of the loan is arm's length as well as the interest rate paid. And often we forget about the volume of the loan. Would a third party lend us that amount of money? And all of this, of course, relates to how much interest you can deduct. A lot of focus on substance and low tax jurisdictions. This is extremely common in Africa. If you have a low tax jurisdiction on the other side, of course, ZIMRA have gone to the extent that they've legislated this. You can be deemed associated even if you're not related, if the counterparty is in a low tax jurisdiction. That's pretty huge. So it means that there's a lot of work to do, additional work, when you have potential risks that are inherent in your model. ZIMRA and the African tax authorities love looking at loss-making entities that are part of a wider group, particularly if the core transaction, if you're making a loss locally, what they're saying is, if you weren't part of a group and you were purely independent, would you continue to do business and make a loss? So is your loss related to your transfer pricing? Really important if you're buying and selling and your core related party transaction is a related entity, because ultimately your profit and loss will relate to that core transaction. There are also significant profit fluctuations. This has become a big explaining point in COVID. We need to explain our financial position in our documentation. A lot of challengement around procurement and logistics hubs. They're often getting a relatively high return, and they're located in strategic locations, which often are low tax, but may not be. But there has been a focus from tax authorities on challenging those type of models. High value transactions of any sort. So it's obviously in ZIMRA's interest to focus on the higher value transactions, because the adjustments that they can make are going to be higher in their pocket. So that's often export and import of goods, royalties and loans. Services tend to be lower value, but still ZIMRA challenged them quite a bit. And in particular, we've seen a lot of challenge on domestic services transactions, which in my personal opinion is unnecessary and quite torturous, but we haven't convinced ZIMRA of that just yet. And probably linking to the earlier point, if your core business is related party, your transfer pricing is absolutely fundamental and critical, because an adjustment is not just like a service transaction. An adjustment would be relating to your entire profit or loss position. So they're hugely high in value. We also need to remember, if there's any type of restructuring, a change in the group, merger, acquisition, this automatically triggers a transfer pricing review. There's a whole chapter in the OECD guidelines about this. But generally it attracts quite a lot of attention from the tax authorities. So transfer pricing, as we mentioned, the main concept in transfer pricing is around this idea of the arm's length principle. The internationally accepted standard, which states that where conditions are made or imposed between two enterprises and their commercial or financial relations, which differ from those which would be made between independent parties, then any profits which would, but for these conditions, have not so accrued, may be included in the profits of that enterprise and taxed accordingly. Okay, it's a little bit long-winded, but it's quite straightforward. You need to transact with your related party as if it was a third party. And any difference in profit will accrue in the correct arm's length location and will be taxed as if they accrued in that location. So under the arm's length principle, transactions should be valued as if they were carried out between unrelated parties, each acting in their own best interests. And then, of course, you need to prove in your documentation that you have then applied that principle. So just having a look at the transfer pricing life cycle, and the concept of arm's length essentially fits into the whole process. You have your planning and design, where you come up with what you believe is an arm's length policy. You then have to document all of this into your local transfer pricing file and prepare benchmarking studies to support your results. And at the end of this life cycle, you have dispute resolution and controversy management, which is, of course, what you're trying to avoid the whole time by making sure your documentation and your policies are robust enough. Along this life cycle is what we call operational TP. And that's what we talked about earlier. The business has to implement and monitor what they do, because transfer pricing is an annual requirement. Each year you have to show that you've applied your policy and that the numbers stack up correctly to the application of that policy. Now we're going to go in a bit to the Zimbabwean specific transfer pricing rules. So Zimra haven't been asleep at the wheel. We know that Zimbabwe's transfer pricing rules follow the OECD guidelines and the UN practical manual, and ATAF have quite a lot of, I don't know if authority is the correct word, but input when it comes to the local legislation. Zimra has introduced a TP return for taxpayers, which is recommended by ATAF. And this is pretty common in Africa. South Africa, for example, took in a very comprehensive one just a few years ago. Zimra were helpful. They also published additional practice notes, which serve as further guidance. The practice notes are actually very useful. And in addition to the TP rules that were in existence previously, Zimbabwe has issued further TP documentation regulations. We're going to talk about that shortly. But in addition to that, the OECD, they're always up to something. There's always some new release from the OECD that, you know, every country has to decide whether or not they'll adopt. But there was a very comprehensive one on financial transactions in February 2020, which Zimbabwe is partially implementing. So in terms of trends, we can see that, you know, Zimbabwe is following global best practice. It's working to ensure that it has the right framework in place to ensure that it can actively monitor transfer pricing from a local perspective. So here, this is kind of, you can read this at home type of slide. So where it's all sourced from, we know we've got the OECD guidelines. We know we have to look at the associated party. We know that we're covering cross-border and domestic transactions. We know that associated entities also include deemed associates. And the other one is not to forget permanent establishments, because of course permanent establishments are also covered under Zimbabwean TP rules. When should transfer pricing documentation be available? Well, this one's quite clear. You have to submit your TP return by 31st of August 2022, and the TP documentation must be in place when the corporate income tax return is filed. And that's pretty critical. And although it's not a strict submission requirement, you have to have it. Zimra will give you 7 days to provide it on request. It's very important to understand that the TP documentation processes, unfortunately, would be impossible to fit into 7 days. So you're off to a bad start if Zimra requests it and you're trying to accomplish it in 7 days, I'm afraid. So for many people in Zimbabwe, they may have been preparing annual transfer pricing documentation already. And for other people, maybe not. But this time is critical. And this year is probably the biggest milestone for Zimbabwean transfer pricing that we've seen in a while. This is probably the most important slide in terms of getting ready for August. What is in this TP document that you have to have ready for Zimra? The content here is OECD compliant. They have followed what you need to do globally. So that's good news, because some of you will operate within larger groups who have documentation already that you can at least use as a basis for your own documentation. It's an overview of the taxpayer's business, description of the corporate organizational structure, so i.e. not just local, but also group, a description of the controlled transactions, including analysis of the comparability factors, a selection of the most appropriate transfer pricing methods, the tested party, and the financial indicator. We've got the full comparability analysis. This is called the functional assets and risk analysis. And we consider this one of the core components of your transfer pricing document. What it is essentially is you have to document the functions, assets and risks of either party to the transaction. And you then have to use that information to classify from a transfer pricing perspective what each of those two entities should be considered from a transfer pricing perspective. So it could be that you're saying they're a service provider, they're an IP owner, they perform strategic management services, they're a limited risk distributor, they're a fully fledged distributor, whatever. You have to do this functional and asset and risk analysis to classify your activities in kind of transfer pricing language. We then have to go ahead and do industry and economic analysis. And economic analysis, or the benchmarking study, is the second most critical part of your analysis, because this is essentially how you support the arm's length nature of the transactions. A benchmarking study is essentially a study done on an independent database, which looks for comparable data to that of the tested party. And let's say that the tested party is your local entity in Zimbabwe. So we say this Zimbabwean entity operates in this industry, does this functions, bear this type of credit risk, has this type of assets, has this type of inventory. And we populate this type of information into a database to identify comparables that perform similar type of activities. We then get a range of profitabilities for those entities, and we test our local profit against this independent data. And so long as the local profit falls within this interquartile range of independent results, you've got a solid defense for your transfer pricing. There's lots of different types of economic analysis you do and methods that you can use to support your transfer pricing. It is technical and it's quite complex. It's probably, if you've not looked at transfer pricing before, it's not something you're familiar with as yet, but they're key components to your documentation. As well as that, as your industry analysis, you have to disclose if there's any advanced pricing agreements. You have to actually conclude on your transactions and provide various other information that might materially impact on the taxpayer's position. So the transfer pricing file is long, but probably the most important components are you describe how the transactions are, the group works, you do your functional analysis, and you do your economic analysis to conclude. Now, these are the transfer pricing methods. So we talked about you have to do economic analysis. So economic analysis is not just something from a business or commercial perspective. We have to use one of the OECD acceptable methods to support the arm's length nature of our transactions. Zimbabwe has aligned with the OECD on this and accepts the same type of methods. We unfortunately can't really invent our own methods, and we have to follow one of the standardized methods. This is very technical, so I'm going to just give a brief overview of some of these methods. It's split between what we call traditional transactional methods and profit-based methods. The most commonly used one is the TNMM, the transactional net margin method. And that's basically like I described in that benchmark just now. It's essentially where you compare a profit, and the profit can mean operating profit, it can be return on, it can mean many different types of profit. It depends which is the correct one. But essentially comparing that to the independent benchmark. So it's a profit-based comparison. We then have a CUP, which is a comparable uncontrolled profit. And that, for example, is commonly used for a royalty payment where you've got a particular price. Maybe it's 3% of sales. And that is basically identifying independent legal agreements where and comparing it to the price. And it's a price comparison as opposed to a profit split. But in each of these methodologies, the analysis is robust and follows a very detailed TP process as to what's the correct method and how is that method applied. And all of this juicy stuff you must have in your transfer pricing documentation. There are more complicated models, but which are becoming more common, like the profit split model. And that is essentially where you allocate a routine return to various entities for their activities, and you get the residual profit and you split it through a contribution analysis. It's actually becoming more and more common and becoming a preferred method globally, but it's only in very, very specific circumstances. Penalties. So what happens if you don't get all of this good stuff into your transfer pricing documentation? First of all, of course, we'll have an issue with compliance, and you've got 7 days to chat to the tax authorities. So for a TP adjustment will result in additional income tax, a penalty of 100% of the additional tax where it's evident that this is tax evasion or a fraudulent scheme, a penalty of 30% where the documentation is not in compliance, a penalty of 10% where the related party transactions are not at arm's length, but contemporaneous documentation is available. So you're already reducing the penalty possibility, even if you have a TP exposure, just by having compliant documentation. So there's no getting away from the documentation. And of course, without it, you're a key potential audit target. Now I'm going to hand it over to Hammond to talk about the TP issues trending in Zimbabwe now. So Hammond, over to you.
Thanks, Cabrini. I don't know if you can see me on the screen.
I can certainly see you, so I think we're good.
Okay, I can't see myself, so I missed a little bit of your presentation because my Windows decided to do an upgrade in the middle.
Oh, shame.
I'm hopefully all back in, and hopefully everyone can hear me. I don't know if we can check. Is there? Okay, I think I'll assume that everyone can hear me, and it's not just you and me talking to each other.
I hope it's not you and me talking to each other, but if there's any issues, please send a message on the chat box. But I think we're good, Hammond. I think we're good.
Okay, thanks. Okay, so in terms of Zimbabwean TP issues, part of the thing that we find on the ground is that there's a lot of the time the understanding of who an associate is not clear, and some of that confusion comes from the disparities between the definition of an associate for tax purposes and the definition that you will find in accounting treatments regarding related parties. So just to point out that not every related party is necessarily an associate for tax purposes. And why it's important to understand this is that sometimes you over include in your transfer pricing documents things that or relationships that probably do not need to be in there in the first place. And what that results in is that you can end up over documenting or documenting transactions that need not be documented. So basically, if you're dealing with someone and they are not an associate or not a deemed associate, then it ends there in terms of the transfer pricing documentation requirements. So broadly, the definition of associate is in Section 2A of the Income Tax Act. It's also supported by 2B, which I'll talk about on the next slide. But it's designed to be relatively broad in terms of who would be covered there. So the first important part is that Section 1 of 2A, which is the broad definition. So it basically includes anyone other than employees. So transfer pricing doesn't apply to any relationship with an employee in the context of an employee relationship purely. And it goes to saying that It includes any person who acts in accordance with the directions, requests, suggestions, or wishes of another person. Whether or not you're in a business relationship and whether or not those directions, requests, suggestions, or wishes are communicated to you, both persons shall be treated as an associate of each other for purposes of this act. So what that's trying to achieve there is that it doesn't just limit you to the legal relationship. It will also include where there's significant influence per se, or you have people behind the scenes that maybe pull strings, lack of better word, if behind the scenes there's a puppet master and he directs how things go. That can cause a trigger, obviously quite often hard to prove in practice. Then what they go on to do is with the rest of the points is they include a whole long list of specific inclusions. A near relative, a partner of a person, a partnership in which there's more than 50% control, trustee of a trust, a company which is controlled by the person, where you're in partnership, the other partners, person is a trustee of a trust or any other person who benefits under the trust. So it can extend to a relationship where you have a structure with a trust and the beneficiary of the trust could be an associate. In the case of companies, it looks to control of the company. So if a person either alone or with other shareholders control a company, makes them associates of each other. And that can hop through different stages where you have, once you create a link to one associate, and then you have a link to another associate, you can find that the spider web grows and you have a relatively broad linkage of associates. If we can just go to the next slide, Cabrini. Cabrini?
Sorry, yeah, it's playing tricks. Here we go.
Yeah, okay. So this elaborates on the common things. So in most instances where this applies, you're going to have it dealing with relationships between companies. And for you to be an associate, there must be this control element present. Okay, and control can come from, first of all, controlling the majority of voting rights attaching to all classes of shares in the company, whether directly or through one or more interposed companies, partnerships, or trusts. So you want to say, ultimately, for there to be a connection and for you to be associated, the first step in testing company type relationships is there a control element present? And control in the context of Zimbabwe is typically, just when we're talking about voting rights, is a mere majority control of those voting rights. It does go on, however, to say, is there any direct or indirect influence that, if exercised, results in this other person factually controlling the company? So control can also come from other things. So you can have a situation where a shareholder is maybe a minority shareholder, and it doesn't then meet the first test there, that they don't have the majority of voting rights. It doesn't automatically then fall away that they're not associates. If, for example, there's something in there like a shareholders agreement or management agreement that grants maybe the minorities the ability to run and operate and control the entity, then it could still fall in there. So it's important to not just look purely at shareholding. a good starting point is to look at shareholding and then see what other layers are there in terms of additional contracts or arrangements that may suggest that a shareholder or a shareholder up the chain in a group of companies is able to exercise that significant influence, which could result in influencing of pricing. That okay, we can carry on, Cabrini.
I think it's allergic to you, my slide deck. Okay.
Okay. So in addition to all of this with the associates, and Cabrini touched on this earlier, is this aspect of deemed associates. Now, this is kind of a mechanism that was introduced that basically said, I think the purpose of it was, often you can structure arrangements so that it just doesn't look like you're related, and you can hide it behind a whole lot of things, and it becomes extremely difficult to determine whether someone is a true associate or not. So Zimra took a kind of a easy shortcut method and just said, okay, well, save us all the hard work of trying to unravel big structures. The likelihood is that if there is a transfer pricing issue, it's going to be in a low, potentially housed in a low tax jurisdiction. So they put in this deeming provision that just basically said, if you transact with anyone in a low tax jurisdiction, I don't think they use the word low tax jurisdiction per se, but that's what they're meaning. They call it something where an advantage, a tax advantage may be given. Then you consider to be an associate, a deemed associate, and then all of the transfer pricing rules apply in terms of those transactions. So that considerably broadens the scope of our transfer pricing legislation to go beyond just the immediate normal aspects that you would ordinarily find. Now, that in itself, it brings in quite a lot of problems practically, because first up is that you will find in any business type entity that an international dealing that you're going to come across, that you at some point you're going to stumble on, that you'll transact with a low tax jurisdiction. So they didn't specify which jurisdictions were covered in the actual legislation, but they brought it in the annual transfer pricing return. They've got a long list of the typical jurisdictions. So it's all those. If you can think of a tax haven, it is probably in that list. But a couple of other ones one other one that was a bit odd to include was Mauritius. And we know that Mauritius broadly could have been considered at some point in time to be a form of tax haven. But at the same token, we have a double taxation agreement with them, and they've gone through quite a lot of measures in recent times to shake that image of being a tax haven. So practically speaking, you will also find in Zimbabwe is that just for various reasons, a lot of people do deal with Mauritius. It's a common jurisdiction where things happen and go through. So be aware of that. Other one that is quite common in where transactions occur So with Singapore, there's another one, and that's on the list. The real practical issue comes here is when you have to try and prepare your transfer pricing documentation, and this person that you're dealing with that happens to be sitting in Mauritius is really, really, truly not a true associate. They're just a supplier that you're dealing with. And Zimra comes back to you and says, I need information about this, and the burden of proof is put on you to discharge it, but this is now you're requesting confidential commercial information. They won't want to share maybe what margins they're making with them. So that is a practical challenge. One of the ways that I saw recently in terms of how it was overcome, and it kind of depends on what type of relationship you have with maybe your customers or suppliers and whether they're willing to help. But they agreed to share information directly with Zimra, so that no confidentiality issues in the commercial relationship were breached. So, but that is really, it's something that just needs to be managed on a case-by-case basis, because sometimes you will have difficulties. And it may then be a case of you having to prove certain things in your transfer pricing documentation, take in some assumptions and some element of incompleteness that may creep in, particularly around maybe when you're doing functional analysis, for example, on a deemed associate. It will be difficult to understand all of the functions that a counterpart might have. But if that is the case, you would nevertheless document your limitations, so that it will be clear that you've applied your mind and you've come to the best possible scenario in the circumstances. In terms of the audits, the audits that we're seeing out there, we are seeing an increase in TP audits by Zimra. They introduce a lot of the time that the audit is a transfer pricing audit, and they sometimes never start with even asking for your transfer pricing documentation. They will ask for all of your related party information and all the questions that you would typically anyway find answered in your transfer pricing documentation. So just the advice there when that happens is that try and direct them towards your transfer pricing documentation if it is robust and you are happy with it. The type of responses you should be giving is saying, we've got this all covered off, it's all in here, please have a look at that. We're happy to provide supporting evidence that supports what we've documented and tested. There's a reason why they don't like to go the transfer pricing route. Okay, for one, it is there's less opportunity to make money out of arguing transfer pricing issues when your documentation is in place. The reason for that is, one, Kabini mentioned the penalty model. So if you approach an audit as a transfer pricing audit and you've done all that you can in terms of the compliance and you've got robust documentation, the ability to feed on penalties, which they like to do, is lessened or it's fixed to a certain extent. The other thing that causes them not to go this route, what I can see is particularly in regard to domestic transactions. So with domestic transactions, there's a provision in our transfer pricing laws that if a transfer pricing adjustment is made, you've got to make a corresponding adjustment. So they're obligated to make a corresponding adjustment. So if they say you purchase something from a local supplier that's a related party, and they're saying no, it was overstated, you reduce it, you've got to make the correction on the other side. So it becomes, unless that other company has maybe got a different tax rate for some incentive type tax rate, or that other company has got a tax loss and it's trying to be used up through that. In the majority of cases, you'll find that it's going to be tax neutral to the fiscus. So they've wasted their time doing a whole transfer pricing investigation if it results in no real gain to them. So what we've seen, the approach that they've tended to do here, because I think they know that is the case, is they're going back a bit to focusing on the pre-transfer pricing type powers. So the tests, like as to whether expenditure is deductible under the general deduction formula. They look into applying the general anti-avoidance rules. Is this a scheme for tax evasion or avoidance? They look at the statutory limitations on deduction of management fees. Those type of things that they try and squeeze the amount on one side, because then they're not obligated to go to the other side and say, you overpaid tax. They will completely ignore the other side. So in short here, I think just when this comes up, bear those things in mind, because that is the common direction that a lot of this takes. And it's important to try and steer these processes, because they are a process and they take time. Steer them back to your transfer pricing with these type of arrangements, because for starters, you would have gone through a process there that should assist in any ways as regards aspects such as general deduction formula. You would have, if you'd done it well, there wouldn't be doubt as to whether the expenditure is deductible on the basis of things like no actual service was given. That would be covered in the functional analysis, etc. That will show that these are the activities that entitled that company to earn income and charge this amount. So it doesn't make all this TP documentation irrelevant. In addition to this, there are a lot of these things that have been tested from a TP perspective or from just the general basis of taxation. They're landing up in disputes, which will go through a long court process. More often than not, it will land up going the long road into a court process. All of this stuff, particularly the transfer pricing documentation, is the evidence that you'll have and be able to present as the evidence required for you to discharge your onus of proof in a lot of instances. So it is very essential, and unfortunately, we do operate in a system where there's not always, it doesn't always operate on an administratively fair basis. They do take one thing with these investigations is a lot of time. So it's important to direct them in the right way. Just from a risk perspective, why we've seen this transfer pricing becoming a risk. Our environment is conducive to promoting transfer pricing issues. So any regulator out there will be aware that the policies that get implemented create a conducive environment to encourage abuse of transfer pricing. Okay, you take an example, statutory liquidations at a suboptimal exchange rate. You know, it's not a tax driver of transfer pricing, but transfer pricing can be a solution to that problem to some extent. So you may find that authorities are alive to that risk. I've seen instances where, for example, the RBZ Economic Inspectorate has been interested in examining transfer pricing documentation. And that's for a non-tax purpose. The other changes, difficulties that are there is that there's often, it's very difficult to find local comparative data for testing. Our legislation does recognize that if you can't find domestic comparables, you can obtain international comparables, which is where most land up going. Obviously, we operate in a very different environment to a lot of countries. So you've got to take those and apply your mind in terms of making appropriate comparative adjustments which are permitted, to recognize that it may not be exactly the same as somewhere in the first world. We also see the interplay between anti-avoidance rules I've already talked about, thin capital rules, etc. One key thing that there's a lot of focus on, that ZIMRA for some reason just really has an issue with, is group management fees. Both local, domestic and international. They somehow think that a company in a group of companies operates in a silo. And that is not a commercial reality in a lot of instances. Groups are formed to pursue group interests, and they typically have group management that don't just sit there waiting for dividends to come. Successful groups are actively involved in the management and support of their subsidiaries and should be compensated for that. They particularly don't like lump sum fee arrangements. They don't like percentages of revenue type arrangements. And I think to avoid that is that move to more like a cost plus type model is probably more appropriate, and then benchmarking, supporting that by benchmarking analysis will help in making those aspects more defendable. They expect you to keep timesheets, etc. A lot of that's not practical on the ground, and you've got to have a well-documented basis of how these costs are also allocated on a fair and reasonable basis. Other aspect that often comes up is domestic intergroup loans. These are often just benchmarked to what the banks do. But I think it needs to be borne in mind that a bank may have a different risk appetite than a group company. So it's not always appropriate to merely just take a bank rate, but it is probably a broadly good starting point, and you may need to make necessary adjustments to reflect the appropriate risks and roles that have taken. The one thing that is often common in Zimbabwean, but probably not a considerably high risk transfer pricing area, is foreign loans. The only reason for that is the foreign loans are regulated by the regulator. under a framework that's defined, that has certain maximum caps, etc., that everyone applies has to stick to within that framework. So broadly, when I say it's unlikely to be high transfer pricing risk, is that they will, if everyone, including your competitors and all other unrelated persons, are subject to that same framework and are borrowing within that range, you're likely to be within that range, the comparable range as well. Nevertheless, you have to document that often, how you've arrived at those conclusions, etc. One thing that is not often considered as intangibles. Now, we've seen a lot in Zimbabwe, where over the past few years, innovative manufacturing industries, etc., have been looking to promote import substitution, and have developed in this market. There's some competitive and well-developed brands that are strong in our market. And those maybe sit in somewhere. The actual legal ownership of those may be sitting in a different entity to those that are actually using them. So just bear that in mind, is that it's not only things that you've actually transacted in that you should be thinking about, but it's things that haven't been charged for that may have needed to be. We also see often disputes between tax heads. So legislation is not always follows all the other legislation. So you will have a mechanism put in place that applies to income tax, but they haven't thought of the consequent impact on VAT. So an example is there doesn't seem to be any provision in the VAT Act that would suggest that you would account for VAT on a transfer pricing adjustment. But you may find in your investigations is that ZIMRA likes to go and say, okay, we're making a transfer pricing adjustment, and we add in on all of these other things. And it can also include potentially things like withholding taxes, etc. I'll tread very carefully there, because a lot of the instances they don't have the legal capacity to impose these additional other taxes on adjustments, because a lot of them relate to actual transacting, not repricing of arrangements to arm's length. I'll touch briefly on advanced pricing agreements. We don't see these in Zimbabwe, yet there should be there. There has been submissions made to ZIMRA to have these in place. In addition to that, to have certain minimum criteria. So some simple transactions where you can say, okay, well, it's acceptable to be within this range of markup, which you see in other jurisdictions. It makes the compliance burden a lot easier on particularly the smaller entities that don't have the full clout to be able to afford or the resources to do these transfer pricing documentations to the full extent. We'll just hope that type of thing will come through. It will simplify it. Mutual agreement procedures, just agreeing between jurisdictions on how things are shared up. Just to note that our legislation provides for that, but it only applies where we have double taxation agreements in place. Okay. Thanks. Cabrini, I don't know if there's anything you want to add to what I've said, or?
No, all very clear, Hammond. We are up on time, so I'm rather we can quickly wrap up. I'm sure people have other places to run off to. But I think, what Hammond and I touched upon today is that basically there's no getting away from transfer pricing. You need to assess where you currently are in terms of documentation. There was a number of questions that came through on the chat and questions and answers. And one of them is, do you need to prepare transfer pricing annually? The answer is yes, it's an annual requirement because the numbers change every year. Another question that came through is, do you have to have full TP documentation if they request it after 7 days? And the answer is yes, it's full documentation in terms of those components that we listed in the last slide. And there was a number of other questions that we will deal separately with. But really it's about figuring out internally how to progress with transfer pricing. And between myself and Hammond, we can assist with any transfer pricing queries you have. One of the points of this seminar is to help businesses understand what CIMRA is up to and to give some practical guidance, because transfer pricing is not a straightforward area. But I wanted to thank Hammond for joining us and everybody for joining us today. It's been great. And please email us with any questions. The other question asked was, are we sharing the slides? We will be sharing the slides, and we'll be sharing a link to the video as well. So you can rewatch myself and Hammond's facial movements to your pleasure. And we're very happy to answer any questions. So Hammond, I'll leave it over to you just to wrap up on your side.
Okay. Yeah, thanks everyone. We'll try and go through all of the questions. There's quite a lot of questions on the chat group there. Cabrini, I take it we don't have any time to really address any of them.
We can answer them live. If you like, and anyone who wants to stay on can stay on.
Okay, so I'm just having a look. Slides. Will Zim join CRS FATCA soon? It's unknown. We're not yet on that common reporting standard. It doesn't mean that no information can be shared. So a lot of our tax treaties do already allow for the sharing of information, particularly that's relevant to tax matters. That's the short answer to that. Confirm TP returns are required from year 2021 onwards. The TP return, I'm trying to think, we're December 2021 onwards. I think it was applicable to the year before, if I'm not mistaken.
Yeah,
I think it's been there for a couple of years.
Yeah.
2020 onwards. I've just received a private message confirming that. TP docs were required from 2016 onwards. So 2016, it came in from 2016 tax year, the legislation. There was a bit of anomaly, and I suppose it's a grey area, is they only brought in the documentation regulations much later. So they said TP applies, but they didn't have the TP documentation regulations. But there was largely earlier application just based on OECD.
And Hammond, maybe to add to that point, how other tax authorities dealt with that is they actually basically say, yes, the first legislation you did have to have TP docs, and now we're just clarifying it for you. So there is this, you know, since it was introduced, you're supposed to comply with it, and now the new guidance just basically makes it more clear. But typically where the tax authority wants to, they will request documentation since it was introduced, which it can be quite disconcerting. But certainly we need to focus on current years, getting up to speed for August, and then considering if there's historic periods that need to be covered. And kind of taking a pragmatic approach to that, because certainly the tax authorities can request.
Okay, and then when interest rates worldwide are nearly 0% negative in some countries in Asia, is it allowable to have interest-free loans? I think in the domestic context, we don't have interest-free loans. In fact, we don't have loans as of this week, since the Reserve Bank banned the lending of all money. But putting that aside, interest-free loans, I would think in the Zimbabwean context, for domestic loans, it's unlikely that you would have a scenario where it's interest-free, because our interest rates are typically high, inflation is typically high. Having said that, it's not in every single instance that a loan should bear interest. And without getting too complex with it, is that you go, like Cabrini was saying, you look substance and legal form. Often sometimes the substance with loans may be that they're more characterized as being equity. If no interest rate was ever contemplated, it's not intended for this money to be repaid, etc. You can justify it, but it will be particular circumstance driven. As far as obtaining independent data, how we have access database housing and monitored and maintained.
I think that was
for you.
Yeah, sorry, I can't actually see the questions because I'm on the shared screen. But so that's regarding the databases. So basically, we use the royalty stat database. There's a number of ones they use Amadeus in Europe, and they use royalty range and Orbis in Africa. But basically, we at Regan van Rooy have access to this database. It's got about 30 million different companies globally. Africa needs global data because we simply can't get African data. So we start with the global, and this is maintained independently. And essentially we license access to that, and that's where the data has come from. And the tax authorities also have access to these same type of databases. So I'm not actually sure, Hammond, if you know what database ZIMRA might use in audits. Are you aware?
Not offhand, no.
Yeah.
Probably none.
Yeah, they often will lend from their tax authority cousins. So, but essentially there's about a handful, 5 or 6 type of databases that all the transfer pricing experts globally will use, and then you'll use the one depending on where you get the most suitable criteria for the region.
They're also not permitted to use data that you cannot access. So they can't have some database that is only their own and rely on it. So they've got to rely on ones that are generally available.
And that's why all tax advisors and tax authorities, they don't maintain their own databases. They license it from kind of recognized, well-known data providers to ensure its independence. Yeah, because you can't fight an argument if you can't show the data to prove it. So, yeah. Is there any other questions there, Hammond? Sorry, I'm blind to it.
I think from the ones I can see, we're complaining mostly that they couldn't see me.
Of what?
Yeah, everyone was wanting to check me out. But
Hammond did his hair especially for today. This is terrible.
I even put on a tie.
Oh.
Well, I think we can probably close off there, Cabrini, and just say thank you to everyone. Thanks to you as well. And thanks for the great participation. I think we had close on 100 participants, which is great.
Perfect. Yeah, thank you, everybody. Thanks, Hammond, and thanks, team. And we really look forward to talking to you about all you need to know about transfer pricing in Zimbabwe going forward. Thanks again, and have a great day.